Have you ever wondered how some companies get absolutely massive before you ever even hear about them on the stock market? Well, it's all about big money moving behind the scenes. Today, we're going to pull back the curtain on the high stakes and often kind of hidden world of private equity.
I mean, it's a fantastic question, isn't it? You see a startup just explode onto the scene and then boom, a few years later, it's a household name. But how did it get the fuel for that incredible rocket ride? Well, it really just boils down to a few key ingredients.
First up, you need capital. And look, we're not talking about a little bit of seed money here. We're talking about serious, game-changing capital. The kind of money that builds factories, hires hundreds of engineers, and launches marketing campaigns across the globe.
And that capital, it has one purpose: growth. Not slow and steady, but rapid, explosive expansion that just completely takes over a market.
But of course, with that level of ambition comes just an immense amount of risk. The very real chance that it could all fall apart, that the huge bet just doesn't pay off.
And finally, if it all works, the reward. A massive, massive payoff that makes all that risk totally worth it. Capital, growth, risk, and reward. These are the pillars of private equity. So let's dive in and see how this whole thing actually works.
So where does all this money even come from? It actually starts with a concept you're probably pretty familiar with, even if you don't know the official name for it. It's the simple idea of pooling resources together to make a much bigger impact. And here's the formal term: collective investment schemes. It sounds complicated, but it's really just a fancy way of saying a bunch of people or institutions put their money together into one big pot so they can invest in things they could never afford to on their own.
And this picture illustrates the idea perfectly. Lots of smaller streams of money all flowing into one giant fund. But, while the concept is simple, who gets to invest in which pot? Well, that's where things start to get really interesting. You see, in the world of investment funds, there's kind of this invisible velvet rope. On one side, you have the funds that are open to everyone, and then there are the exclusive clubs, operating under a totally different set of rules. Okay, so this slide shows a really crucial split in the investment world. On one side, you've got authorized funds. These are your mutual funds, things that can be sold to any retail investor, and they're heavily regulated to keep the public safe. But then, you have the unauthorized funds. Now, they're perfectly legal, but they cannot be marketed to the general public. This is the exclusive world for the big players, for institutional investors, and that is exactly where we're headed today.
And that brings us to the main event. We are stepping past that velvet rope and entering the world of private equity.
So, what is it exactly? Let's break this definition down. It's medium to long-term finance, which means this isn't about quick stock trades, this is patient money. It's provided in return for an equity stake, meaning the investors literally own a piece of the company. And what's the target? Potentially high-growth companies. They are hunting for the next big thing. And who's putting up all this patient capital? Well, it's not your average person. The money comes mainly from these massive investing institutions. I'm talking about the huge pension funds that manage your retirement, or university endowments, or insurance companies. This is big, sophisticated money with very, very long-term goals. So what's the game plan once they have all that money? They follow a very clear playbook. Step 1, raise the capital. Step 2, invest it. Step 3, grow. Now, this part is absolutely crucial. This isn't passive investing. Private equity firms get actively involved. They might bring in new management, streamline operations, or make strategic acquisitions, all to rapidly increase the company's value. And then finally, step 4, the one that matters most, the exit.
See, in private equity, you don't make your money when you invest. You make it when you leave. The exit strategy is everything. It's how you get that capital gain. So how do they cash in on these huge bets? There are really 4 main ways out. First up, you've got a management buyout. The PE firm sells its shares back to the very people running the company, who now get to take full control of the business they've helped to grow.
Second is what's called a secondary buyout. This is where they sell to another player in the exact same game. One private equity firm sells the company to another one, basically passing the baton to a new owner who thinks they can unlock even more value. Third, we have the trade sale. This is often all about synergy. A large corporation in the same industry just buys the company outright, maybe to integrate its technology or its market share and create a new powerhouse.
And finally, the exit that everyone knows, the initial public offering, or IPO. This is the big moment the company goes from private to public, listing its shares on the stock exchange for the very first time. It's usually the most lucrative and high-profile way out, ringing the bell and opening the company up to the entire world of investors.
Okay, so we've got this high-stakes game being played by giant institutions behind a velvet rope. Why does any of this matter to the rest of us? So let's just boil it all down. Private equity is patient, long-term capital. The firms are active, hands-on investors, and they are laser-focused on high-growth companies that are outside the public markets. And their entire playbook from start to finish is designed around one thing, the capital gain they make on the exit. For better or for worse, this powerful engine of capital is constantly shaping the corporate world we all live in. Which leaves us with a final, kind of provocative thought to chew on. Is this world of private equity a vital engine of innovation? Taking the risks that others won't to build the great companies of tomorrow? Or is it more of a high-stakes, high-leverage gamble that's more focused on financial engineering than it is on real, sustainable growth? The answer? Well, it's complicated, and it's definitely something worth thinking about.